Hi, it's Mark Coopersmith. And in my ongoing set of conversations with leaders in the innovation and entrepreneurship community, it's a distinct pleasure of mine today to sit down with my friend and colleague and fellow Cal Bear, Jed Katz. Jed, thanks for joining me and us today.
Of course. Happy to talk to you, Mark.
So we're going to actually have two conversations today. Hopefully you'll have a chance to see both of them, those of you watching. This first one is going to be about how venture capital funds are structured and work. And with that in mind, what I thought I would do would be to provide a little bit of a background and introduction on Jed as well. So Jed is the founder and managing director, along with another Cal Bear, and I guess you have three managing directors now in your fund, of Javelin Ventures, Javelin Partners.
Yeah, Javelin Venture Partners.
Javelin Venture Partners. I was just saying, I knew that both of those were in there. Javelin Venture Partners. Jed graduated, has an MBA from UC Berkeley, and about a dozen years ago started launching your funds. Is that right, Jed?
That's right.
Perfect. This is, as I understand, you've just launched your fifth fund. They're typically in the $125 million range, plus or minus, if that's correct. So you've been through this cycle many times, and you focus on early stage and early growth stage companies. So do us a favor, if you would, share a little bit more, kind of fill out a little bit of that background, and then let's launch into this topic of how venture capital works and how funds are structured.
Sure. So yeah, Javelin's been around about 12 years. And like you said, each fund is around 125 million. We'd like to describe what we do as investing in late seed or early Series A rounds. So anywhere from $1 million to $5 million. And we're usually the first institution that comes in, first venture fund that takes a board seat and really helps guide the team with their initial recruiting, their strategy, putting all the building blocks in place and getting ready to then be able to raise future rounds.
So when you say late seed and early A type of thing, what's the evolution, kind of what's the maturity level of the fund, of the firms that you're typically investing in, of the startups?
There is something there. There's some signal. So they've launched something. It doesn't necessarily have to be revenue, but it might be, there's some usage patterns. There's some virality we can look at. They've done some early recruiting. There's some signal that there is pull from the universe. The universe wants this to exist and thrive, and we can then see a longer term vision of how they're going to grow and hopefully grow explosively and put up barriers and build a great business.
So they started to answer some of the T questions, right? Timing, traction, those types of things. You've got, there's signal amidst still some of that early stage startup noise.
Yeah, and the word traction oftentimes gets confused with revenue. So we like to use signal instead.
Got it.
Yeah, it has to be real. It has to be more than just an idea on paper, unless you're a very known entrepreneur to us and we're dying to just invest in whatever you do next. But typically,
the first two worked, we'll give you a third try. Yeah.
Yes. Typically, there's been something built, something launched, or about to launch, and it's been thought out enough, or it's a sophisticated vision of what they want to build.
Right. Fantastic. So that's where you typically invest. Now, you've gone through, you're now raising your fifth fund. You're in the midst of raising, you've already launched your fifth fund. Tell us, kind of for those of us who aren't as familiar with venture capital, kind of how a fund works, what that often typical 2 and 20 looks like, the different roles of players, of investors. I'm a limited partner in a few funds, for example, that are early stage, small investors like myself can be in, but tell us how those funds work.
So our job is to put together our portfolio of startups. And some will succeed, some will fail, and hopefully some will become huge. We go out and raise money first from family offices, from universities, endowments, individual investors, whoever it is, and we pool together, in our case, $125 million. We then spend the next 3 to 4 years investing in startups. And we'll put a little bit in first, as I said, 1 to 5 million. We'll save 1 or more X that amount for reserves for each company. And we'll put together somewhere in the neighborhood of 20 companies in a portfolio. Over time, as I said, some of those will work, some won't. And hopefully we produce a return that is far above 125 million. Once we return the 125 million to our investors, we then get a piece of the profit after that, which is called carry, and that's the 20% you referred to. Along the way, we also take a management fee each year just so we can support our staff, our office expense, our travel expense, everything we do to support our portfolio companies. But that's not really how we make money. The way we make money is by being right on choosing startups and helping guide them to big exits. And then once there's a big profit to take, which will take 5, 6, 7, 10 years in many cases for a portfolio, that's when we really start making money.
Perfect. So if I were to, so there's a common term that says like it's a 2 and 20 fund, which means a 2% management fee, which you were talking about. So if it's $100 million fund, a 2% management fee would be $2 million a year.
That's right.
That would then basically cover your basic operating costs. But then the 20% is once all of your investors get back their 100 million, you then earn 20% of all of the excess returns above that, right?
Exactly.
Okay.
Yeah, and typically venture funds don't take those returns until after that first 100 or 125 has been returned. In some cases, they do take it along the way because they're so convinced their final return will be high enough.
Right.
If it isn't, they would have to pay that back.
Right. So if we were to use an example of, let's say, $100 million fund that ended up generating in exits and returns $200 million in total return, well, the investors would all get back their 100 million first. The management fee would be taken off the top, but then that excess of $100 million would then earn $20 million additional back to the fund sponsors or you in that instance, right? Or the fund managers. Is that right?
That's exactly right. And then that is divided between the partners of the fund, and if with most funds, they'll share that also with the people, the other associates and principals and other members of the fund who helped them build the portfolio and manage it along the way.
So the real money to be made, especially since you do have operating costs for funds, is to make those right bets. The better I do as an investor, as a limited partner in your fund, and you access that hurdle, that threshold, the better you do. That's really how funds are levered and why you're particularly motivated to get those big returns.
That's exactly right. It keeps you very aligned with your LPs, your own investors. Your job is to maximize the return.
So if you were to say across the fund, as you did, let's say you invest in 20 or 25 or 30 businesses, ventures over the life of a fund. By the way, how long does a fund typically live? You've been through several.
It used to be a shorter amount of time. You make the funds usually 10-year funds.
Right.
You invest in 3, 4, maybe 5 years, and then each company is, exists
then
before their exit for 5, 6, 7 years. Now it's more like 8, 9, 10 years. Things are, companies are staying private longer. So the fund cycles tend to be more like 12 years. So it takes a while. I mean, it takes a patient long-term investor that's looking for an outsized return, but it's going to take time.
Right. So you currently probably have most of your funds that are still in existence, at least on the tail end of them, as their companies are still private, but moving towards some type of an exit.
I think we still have 1 or 2 companies in Fund 1 that are still alive. So
at a certain point,
takes a dozen years.
Yeah, at a certain point, if you have that one company left, what do you do with that?
There's a variety of things you can do. You can distribute shares in the company if you want to. You can create just a smaller vehicle and really shut down that venture fund, but move it into a different vehicle. There's a variety or you can try and sell your own shares in some secondary market if it's available and just distribute cash.
Sure. So eventually, even if you have 1 or 2 that are still moving towards that exit, you'll find a way to shut that fund down, because trying to manage all of those funds at the same time, a lot of paperwork as well, I'm sure.
Yep.
Right. Communications with investors, those types of things.
Right.
All right. And as we take a look at that, how 25, 30 companies across a dozen years up to, how do you typically see, is there a general bell curve of distributions? Do 2 or 3 companies typically represent the majority of your investments? Different funds, different partners will have kind of different investment philosophies as well. How do
Yeah,
you try and look at kind of your portfolio and providing that return to investors?
it's a great question. Uh, for a fund like us, it really just comes down to a few outliers in each fund. So the ones in the middle of the bell curve do matter; they all add up. But it's not, the thing that really drives us is getting the outlier, the one that's 100x or a 20, 30, 40, 50x.
Right.
And if you get one of those, the fund is going to be successful. There's a bunch of them that'll go out of business too, where either the idea didn't work or that next round of financing never was able to materialize, or it was an early exit for a relatively small amount of money. There's a bunch in the middle where you might get a 2, 3x on the company, but it's really the 10x pluses that produce the return for the fund. And so what we're searching for when we invest in startups are the ones that have that potential, the ones that can have a multi-billion-dollar exit, and we can maintain a large enough stake along the way.
So this is one of the things that's important for entrepreneurs to understand, which is their business might actually be a good business. They may have come across a good problem that needs to be solved, and they wonder why they can't raise funding. But
Yeah.
it may be that it's a good idea, but it's not a 10x or a 20x or a 50x idea. If it only has the potential in your mind to generate maybe a 2x or a 3x, even at low risk, would you invest, or do your
No,
fund
never.
economics say, no, we
Never.
don't think so?
Yeah, it might be a great angel investment. So
Right.
we might be able to point you to a whole bunch of people that would write $25,000, $50,000 checks, and that might be a good path for you. But look, 99% of the time, and I'm not exaggerating, 99% of the time, we're saying no to companies, and most of those are good companies. Very often, we are having active debates in our partner meetings about really good companies, but they don't quite have that potential, or at least we don't think they do at that point.
Right.
We're often wrong too.
Right. Right.
And so it's no slight on those companies. Other investors might think they do have the potential and make the bet, or if it's a consistent thing they hear from all the venture investors they're targeting, either their business model isn't a big enough swing, or they need to go to a different class of investor that's looking for a great but a smaller return.
So this is something that I think is really important for entrepreneurs to understand, and they often get it wrong. And that is, understand the model, the investment model of the fund that you're talking to, of the partner that you're talking to. Because some funds may be perfectly happy with investing in a number of businesses that I think are think are relatively low risk, but can return a 3 or a 5x. Others might ultimately be looking for the 100x opportunity out there, which is what you shared. And some companies are just much better fits with some types of investment theses.
For sure. And there's a lot of funds that are smaller funds that are looking for consistent, good returns. They're out there, and there's a lot of angel investors. I mean,
Right.
There's an entire syndicate business now where you can put together a lot of those $25,000 checks and raise real money, several $1,000,000 pretty quickly.
Right.
But if you're going to go to the venture funds, the $100 million plus funds, they're looking for investments that can pay back the whole fund. Okay,
Well,
so
yeah, and think
yep.
about what you just shared, right? If let's say you invest in 25 investments over the life of a fund, and let's say you invest the same amount. I know you don't, but let's say you were to divide that evenly. If just one of those investments becomes a 50x
Yeah,
on your
that's all
investment,
you need.
the entire fund is looking great. All of the other
Right.
24 could go out of business potentially, and you would still deliver a nice return to your shareholders, to your partners.
Now, obviously, the trick is that the 50x doesn't happen every day, right?
That's right.
There's not billion. Although you read about the wins in the tech press all the time, there's a lot more ones that are smaller exits or didn't work at all.
Right.
So the achieving those big returns really requires picking well and a lot of guidance along the way.
Yeah. Well, one of the things that I love about you and Noah and your team is you've been on the entrepreneur side of the table, and Javelin is particularly known, you are known as being a very friendly venture partner, and I mean partner in that partnership perspective for entrepreneurs to work with. As opposed to financial engineering, it's how can we help you get big? How can we help you succeed? And different VC firms really do have different reputations. So from the standpoint of me, while I'm an investor, really being an advocate for entrepreneurs, I always want to find a partner like you investing in my company.
We appreciate that more than you know. We work really hard to be a partner to the entrepreneur and just help them build and solve problems. We don't want to be the ones that ever bring drama to the table. We want to be the ones that they call to brainstorm all the time, and they call for recruiting help, and they call for strategic help. And, you know, it's not just the board meetings, it's lots of interaction along the way. You know, we've all been entrepreneurs, so doing startups is ridiculously hard.
Ridiculously
and I think,
difficult.
and it takes everything out of you. And I think the more people you can surround yourself with, both on your executive team, but also on your board and the investors that just want to see you win, they just want to help you in any way they can, you're going to stay more sane and your chance of success goes up.
Yeah. So I have one last question for you as we wrap up. And this is a question that I'm asking kind of on behalf of the entrepreneurs that will be pitching to you and other venture capital investors. And that is, if there was one thing that you wish entrepreneurs knew about kind of either the way funds are structured or how you operate or whatever, that you would like them to understand before they walk into the room, or the way that they construct their pitch, what might that be? What piece of advice might you offer to an entrepreneur before they come in and meet with you?
Yeah. So I have like an hour-long speech on this subject. That's somewhere in the YouTube
we'll
sphere.
have to figure another time for that one. Yeah.
Well, and the short answer I'll say is you gotta kind of build passion, right? You gotta find a way to make all the partners in the room, or certainly your champion in the room, want to work with you badly to solve this problem and build this business. You have to be the thing that wakes them up and gets them thinking about it all the time, and just one of the things they want to spend their precious time on, and you want to be the person they want to partner with to do it. That's a win.
Perfect. So to make an uncomfortable analogy to the current virus that we're all battling, you want to be contagious, but you want that enthusiasm and that vision to be contagious, and have everybody in the room catch it and say, okay, we're on. And then good things happen. Is that right?
Yeah, absolutely. I mean, you want to be the one when they've seen 20 to 30 companies that week and they're talking about them on Monday morning, you want to be the one they remember most.
Yeah. That's a great way to close. Jed, thank you so much for those insights. Really appreciate it.
Thanks, Mark.